Rick says, usually bull call debit spreads can be partially risk mitigated with a condor structure. Is there any other way I simply buying puts or parity positions at higher or lower delta that can mitigate risk in any way possible? Well, when you add a condor, you're going to add risk in the condor itself. You're still going to have the risk of the bull call debit spread, but if you do a true condor against it, sure, you're going to collect premium, but now you can lose on two trades, the initial bull call debit and the initial iron condor. Both can still hit maximum loss on the trade, or just even a call condor. So what those are used for more, in my opinion, whether to mitigate the risk, Rick, is the concept of, if the stock starts to move against me, how can I restructure the trade? That's when I look to use potentially a condor, or, as we mentioned in the playlist, the 7 ways to manage a bull call debit spread, converting it to a condor or potentially a butterfly. That's number 5, I think. Maybe just if you left yourself 2 spaces, and we did here, so there's a 31 strike in between. If the stock starts reaching down here, I might buy to close my 32 and sell to open the 31. It might give me a lower profit, but I'm trying to give myself more of a window in that position. Why am I not going into the discussion you want, it seems, about adding something to this structure as it is to mitigate the risk? And it's because your first part of your question seems related to me that you're interested, in doing bull call debit spreads from something that you read. And you saw a couple things or a video out there from maybe a competitor of mine of power options, or maybe just another educational guru. There's a lot out there who says, yeah, instead of doing bull call debit spreads this way, the common boring way that's been done for 40, 50 years, I'm going to go ahead and go further out in time, still in the money, but I'm going to close it early. So I'm trying to shoot for 100% success rate instead of just the common 83, 84, 85. As an educator, when I see a question like that, as an options trading educator, when I see a question like that, you're telling me that you want the risk and reward of the in-the-money bull call debit spread structure. And right now, your market, and the market has been bullish. We're starting to see those warnings, Rick, but your sentiment has been bullish. You want a good probability of 75, 76% for safety. You're good with this 4-to-1, 5-to-1, or 6-to-1 risk reward ratio on this 21, 22, 25% return, even if you do close early for only 12 or 13%, so on and so forth. And I gave you the first part of the answer on what my expectations are, what I'd expect to see, pros and cons of the 2 different approaches, in my humble opinion. Now, when you talk about this is, to me, so we're saying now this is the structure that you're interested in trading going forward. Now, how do I mitigate more risk by adding other positions or adding other structures? This whole discussion that we just had is now negated, because that's not going to be the target return you're looking for. That's not going to be the risk level comparison you're looking for, and you're going to have 4 to 5 working legs on a position. So my comment on that is that using some of the tools that I showed you today, and if you're just on a trial and power options, use some of the back testing tools, set up your structure under bull call debit, and set up your save search, and then go into that back test, and you have access to 3 months of back test, and run the scenarios and see what happens. Analyze the position to see when you might have looked to trigger a loss or anything along those lines. See if it meets your goals. See if what I've taught you and discussed with you, I should say numerically today, from my experience with a parity trade out of the money bull put credit spreads, is what you're seeing with your criteria. Or upgrade, of course, to the historical level of tools for a month or so to play around with that. Then, if that's not meeting your goals, or it was meeting your goals but a couple positions got away from you, now you've got to develop a new trading plan of, I wanted to do this bull call debit spread. I went 35 days out in time. This one doesn't offer weeklies. But what if I did something where I tried to increase risk control by buying a 30 put against the position? Okay. So what do we have here? I sold a call, which gives me a negative delta. I've bought a call, which gives me a positive delta. We're in a bull call debit, so we're a positive delta. So we're trying to go with a smaller negative delta on the put side to balance everything out. And what do I have now? Not the profit and loss chart you wanted to be successful. Your max profit looks huge. Your max profit is down here if the stock goes to 0. Your max profit in the direction you thought the stock was going to go, in the spread position that you wanted, is only $2.50. Now you're trading against yourself for what your original plan was because you're adding an improper, I should say, risk. You've created almost what looks like just a put ratio spread, which is essentially what this is. This is a parity trade to a put ratio spread. And I don't think this matched it, especially because now the risk is exceptionally high compared to the potential return you were expecting to get if the market did what you want. You're risking $2 to make 2 cents in the direction you thought the stock was going to go. That's not it. That's not the structure you want. That answers the first part about buying a put. It doesn't matter what strike you do. It's going to have that same risk reward profile, essentially, very close to it. Might be a higher profit on that upside, but it's going to be very small, Rick. Changes the whole dynamic of the spread and the question you initially asked me, that this is the risk reward I'm looking for in the money for safety, bull call debit spread, leverage returns, knowing I'm taking on a leverage risk. If I go further out in time, do I increase probability? Do I go deeper in the money for a lower cost? Those are the right questions to ask, Rick. Don't get me wrong. But now comes in the tough part of, I want to mitigate risk for what I decided I think was already the risk reward control I wanted with the probability. Is that putting me in the right position? No. Now you're just taking away from the initial structure that you had. Let me do a quick condor. I'm going to do a put condor, which would be the same as an iron condor, same risk reward profile as an iron condor and all call condor. And we're going to do it out of the money as we normally would. We're going to do a bull put credit spread at same strikes, 32.30. So that's going to give us an extra net credit, which here, the net credit is going to probably be the same thing of what this parity trade was. The max return of, what was it, 36 cents? Yeah, 35 cents there against the risk of 165. This 2-point spread is going to be almost the same. But now I've got to enter a bear put debit. We're at 35. We're at 36, really, some 4 points above. So I'm going to sell a 40 put, buy a 42, keeping everything at 2 points. And I'm trying to be equidistant to the current stock price, Rick, just to make it clear. So what are we doing? Not that. We're selling the 30. No, I was right the first time. We're selling the 32 put, buying the 30. That's going to be our bull put credit spread, a double essentially equal to the same thing on the bull call debit spread. But what does this mean by itself, Rick? We're adding another $1.65 of risk for another 35-cent profit. And then we're going to do this deep in the money bear put debit spread, selling the 40 put and buying the 42. This isn't bad. You increase the profit to 110 to take on a risk, including the monetary requirement of the bull put credit spread. You got a 290 cost, a debit for this high in the money bull call debit spread. You're in the money bull call debit spread. Then the margin requirement of the bull put credit spread. I'm going to stumble on that very soon. So your total monetary, you're going to pay $290 in, but you've got to have $200 on hold for one contract for the bull put credit spread, right? Because the bear put debit spread doesn't cancel that out. So now you've technically got $490 at risk, or it's really still $290 at risk for the debit payment. But that's going to come, hey, if it goes down here, the bull call just expires worthless. You didn't lose anything but the debit cost, but you got to cover the $2 here. But you made up for it with the $2 you're getting back in the bear put debit. So you make 110 against that risk of 290 to do what? Make almost the same exact return in this range. Did you increase your lower break even? Yeah, but you should have, okay? So your original break even on the bull call debit spread would have been about the same price, right? It would have been about 31.35 if I'm not mistaken. No, it would have been much lower, yeah. The break even actually would have been lower. No, it wouldn't have, Mike. I'm sorry. It would have been 32.65, Rick. I apologize. That would have been your break even with just the bull call debit spread. So you get a better lower break even. You create an upper break even. Not saying that I expect SMTC in the next 35 days to go up 6 points, but you might have to do some management up on this side, on the bear put debit spread. You get a higher monetary return. Almost the same return. It was 21.4, 21.5 with just the bull call debit spread to 22.4 with adding 4 extra moving parts on the position. Did your monetary return go up 3 points? Yes. But so did the total requirement. You got to have 200 on hold and you're paying 290 in debit out of your position to get into it. So you do have 490, but this other 200 is going to disappear if it expires worthless. So the true risk is only 290 from 165. So you didn't quite double it, but here with what you're paying out immediately in your portfolio and to have on hold for this 35 days or until you close it is about 3 times what the risk was to make, about 3 times the maximum profit. So the return is even in that case. Now you can argue that it's 290 versus 110, so the true risk is really closer to 50%, 42%, 35%. But no, remember, this 490 is real. You've got 200 on hold in your account, and you had to pay 290 transaction for the whole thing. So 490 is out of that account right there to make 110, which is the 22.4% of what you've had in the profit. Again, almost the same. I want to see this here, 31.45. Yeah, I think I got the math right on that. Yeah, to 31.65. The lower break even is still almost the same, 31.65 versus 31.45. 21.2% versus 22.4 just for one trade, 2 working legs. Why confuse it? Well, you confuse it maybe if you do what I suggested, you start running some of those tests, start doing some paper trades with the performance, with the structure that you want here for your bull call debit spreads. See how that works out. See how that plays out, Rick. I think you could get to the probabilities and returns that I was showing. As you extend the time period, though, I will say this. If I did 6-month out bull put credit spreads with a higher than 85% return, I'm not going to see an 85% success rate because the market's dynamic. I'm going to be hitting, but let's go to year to date for SPY. So at the beginning of the year, I apologize there, or close to the beginning of the year, yeah, year to date in January, I'm humming along just fine with my bull put credit spreads and still going through. Now, I opened June 6-month out bull put credit spreads with the 85% probability. That's not 6%. I apologize, folks. That's 6 months out. So starting January, beginning of the year, I opened 6-month out June ones with an 85% probability. I still probably did okay. I opened in March to September, 6 months out. I probably would have hit the 50% loss at that time period on most of those trades, even though it's still out to here because of that drop. Timing is important. The further you go out in time. So if I did the 3-month out that you were talking about, I started in January, I went to April. My bull puts, your bull call debits, even if they were 30 days out, 45 days out, in most cases, barring any earnings that you should be avoiding, as I mentioned, we were probably closer to a 90 to 91% success rate with this market trend. And NASDAQ was roaring even more. But again, hey, I did so great the 3-month period, all of January, all of February, of March. I hit my expirations. We've got a 91, 92% success rate. Let's open our new trades from March to June. And we got walloped probably on every one of those trades, hit the 50% loss. Maybe even 70 to 75, you let it run further. What did you do? You just canceled out all of that previous if you allowed the risk to go too high. Then we see some buy signals again, so we get back in. We're doing great, we're doing great, and we're doing great. And we've been doing great. 3 months, 2 months, 60 days, 30 days. That's the key. Back here in April, is there any justification to I would have seen this coming? What could I have done? Would I have seen that coming in this case? July 12th, 2 in a row, bearish sell warnings. So now I'm getting hesitant. All this discussion we've had, it's great for theory, great for structure. I can tell you honestly, I did have some bull puts that expired. I had 3 of the usually 4 or 5 I have open. I have 2 more open for next week. I'm probably going to close those on Monday. And I'm not going to open new positions on Monday because I have seen 2 bearish sells, strong bearish sells in a row. That's usually my trigger to start adding extra hedge to my portfolio, lighten up on my bullish spreads, and I might not be opening any bullish ones right now. I'm not saying I'm opening bearish ones yet. I'm going to buy probably puts. Apologies. I'm going to buy calls on the VIX possibly and some puts on SPY. 515, that's not what I was looking for. There's the light buys. There's the sell warnings. Okay. So yeah, we started to see the sell warnings more briefly back in 3.8 and 3.11. And this one here, this was my concern. 3.21. No bullish. 6 bearish, 7 neutral signals, but that was close and it eased off a little bit, but then we're still here. And then you started to see those drops occur down to 51, down to 50, 61, 50, 51. And that's when you started to see the light buys, 418, 417, and 416. And when you start to see the light buy warnings, now we're getting into 4 and 5 bearish signals as opposed to neutral. And that was right around this time period, which was right around what? Near the bottom. The MACD shows us. And that's when we started getting the last buy signals. And there we go. Okay. So with a couple of hiccups we saw in there too. We saw some when we got to here with this little one. That was in May. You saw the one I pulled up, the bearish sell warning in May 15th, wasn't it, right? Oh yeah, starting May 9th. May 15th was the strong bearish sell right in here. Before what? Before this little dip. And then we never went back to light buy, if I'm not mistaken, after that dip. But then we went right back to the sell warnings, and we've been there, and now we're at 2 bearish sell sentiments.